Hey everybody, this is Rick Mount with Fairway Independent Mortgage here in California, and this week we're going to bring you some quick facts that talk about affordability. Affordability has been a big topic on the minds of people as the recent events of the real estate market over the past year, and especially over the past month, with home prices have appreciating and interest rates certainly on the rise from their historic lows. Affordability has been something that's been a big topic of conversation in the mortgage and real estate world and on the minds of many consumers. So we thought we'd dive into the numbers because I think there's a lot of conflicting data out there in regards to affordability, how it's measured, and what the mainstream media might want you to believe as they typically prey on fear and sensationalism. So I went back to look at some data to see if we can derive where we're at in affordability as measured against historical averages and whether it's still a good time to purchase real estate and how things measure up in today's world. So we're going to dive right into this. Median home price for California specifically has moved up and is currently being reported as $415,770 for the median home price of a single family residence. This is published from California Association of Realtors website, and using their home affordability measure, which assumes a 20% down payment, and at the current interest rate of around 4.5%, that would require somebody to make just under $80,000 a year to qualify for that house, and that's how they measure some of the affordability indexes. So based on that, including principal, interest, taxes, and insurance, you would net a payment of around $2,217 per month for buying that $415,000 median home price with a 20% down payment. So I thought it'd be healthy to go back for comparison purposes to look at where we were at the height of the market in 2007, pre-crisis, and look at where we were. So the median house price at the end of quarter two of 2007 had reached $592,240 and would have resulted in a total payment of $3,328 at an interest rate of 6.47%. So as you can see, we're well below both levels of price and payment as we measure affordability. So from that standpoint, things still look to be pretty healthy, even with the recent run-up in prices and with the recent run-up in interest rates. We're still well below the peaks of both price and interest rates and are still at or near historical lows for interest rates. There are differences per county. For example, LA County, the median home price is a little less than the California average. Areas like the Bay Area obviously pull the complete average up, but LA County reporting a median home price of $378, Orange County $657. Other areas of interest would be Riverside at $285, San Bernardino County, which is the largest county, at a median house price of $169, probably has the biggest variance from one city to the next. San Diego County reporting a median home price of $469, and Ventura County $522. So obviously with the recent run-up in rates, as rates raised from the historical lows of the mid 3% range, starting to approach the mid 4s, on we're up at 5%. We want to look at what that impact would have on somebody's borrowing power, assuming that they qualified or wanted to keep their total monthly payment for principal and interest around $2,000. So at a $2,000 principal and interest payment at a 3.5% interest rate, that would give you a net loan amount or a qualified loan amount of $445,000. So pretty significant borrowing power at that point. But as we move the rate up the ladder a little bit, close approaching 5%, that purchasing power is reduced significantly. At that same $2,000 mortgage payment for principal and interest would qualify you for a mortgage of $372,000. So a reduction of $73,000 in somebody's purchasing power as we move off of our historical lows. So yes, rates are definitely something that have a big impact on affordability, and we want to keep an eye on them as we move forward. So another thing that we want to consider or remember in measuring affordability would be the cost of renting versus owning. And so I went back and dug through some data to kind of see where we're at. And again, CAR and a couple other websites have posted some information that takes into account the cost of ownership, were offset by benefits of buying, mortgage interest, property tax deductions, investment appreciation, measured against the cost of renting that included monthly payment and renter's insurance, and look at the benefits of both things. So in general, for California, it is better for a consumer can save up to 32% per month by buying a property. Now, there are some peaks and valleys across the California landscape. In Santa Clara County, for example, it may be cheaper to own or to rent in that particular county as opposed to owning, just because of the sheer price of the properties. Alameda and Oakland also would be areas that it's really close to whether it would be making sense to own or to rent, and some parts of Orange County as well. But in general, most places are still very affordable, and the cost of owning a property presents many more benefits to a consumer than just pure renting. So as you can tell by some of the numbers that we reviewed, we're still in a very healthy spot as far as affordability, even with the recent run-up in prices in California as well as the run-up in interest rates. We're still well off of our peaks in both categories, and pricing still remains very healthy and very affordable and within the reach of many consumers. So with that being said, if we can help you or anybody you know determine what makes sense for them and their financial situation, we're here to help provide a detailed analysis. And keep in mind, we look forward to working with you again soon, and make it a great week.